afternoon and welcome to Capital Account. I'm Lauren Lister here in Washington, D.C. These are your headlines from Monday, June 4th, 2012. Billionaire hedge fund manager George Soros says the EU is like a bubble and authorities will not be able to meet the demands of the market coming up here. Now, it doesn't keep Eurocrats from trying, of course, as officials reportedly push for new master integration plans. But are they doomed to fail when the mood is this negative? Was the very formation of the EU made possible by this mood to begin with?
Just let it run its course.
We're talking about bull market mania with that Exhibit A. Robert Prechter, founder of Elliot Wave International, is here to explain. And an MF Global trustee takes aim at Jon Corzine himself. In a report, the trustee says he may sue the former CEO and other MF Global executives for negligence and breach of fiduciary duty. The New York Times also reports that Bank of America's top execs and those meant to police them are likely to catch heat for new revelations about the bank's bad behavior during the financial crisis that's come out. Does bear market psychology, we ask, mean we'll see more aggressive attempts to hold bankers accountable? We'll try to answer that. And is the downturn in the Dow a harbinger of a major economic contraction ahead? We'll tell you why the R word, recession, may be making a comeback. Let's get to today's Capital Account. So George Soros is known as many things, but he's known as the man who broke the Bank of England. So, hey, that could be one reason why, when he gives a speech saying Europe has 3 months to save the euro, it gets a lot of attention. Now, here's a snippet of what he said over the weekend.
But we are at an inflection point. After the expiration of the 3 months window, the markets will continue to demand more, but the authorities will not be able to meet their demands.
But we know nothing will stop EU authorities from trying, and German press is reporting top EU and ECB officials are working on a master plan, in fact, to try to get the Eurozone out of crisis, which they will reportedly present at an EU summit in late June. Does any of it matter, though, given the negative social mood? Is the tide flowing against integration? And there's nothing to stop it. And we have to look at this within the context of the bull market euphoria that the Eurozone was born from to begin with. As Soros notes in that speech, in the boom phase, the EU was what the psychoanalyst David Tuckett calls a fantastic object, unreal but immensely attractive. Now, that is something our next guest often talks about, and he pinpointed this euphoria, this peak in positive social mood back in 1998 as a reason why the European Union was destined for disintegration. He's Robert Prechter, founder of Elliot Wave International and author of this book, Conquer the Crash. You can survive and prosper in a deflationary depression, and he is here to tell us what he thinks is ahead. And what he still believes is a deflationary coming up ahead of us, deflationary period. So first of all, Robert Prechter, welcome to the show. Thanks for being back on Capital Account.
Yeah, thanks for having me back.
We love to have you on. So you have been talking about the disintegration of Europe since 1998. I mean, a long time ago. And despite everything we've seen, you still think that we have a few more years, several years, before we could reach a bottom. So what are we looking at in terms of declines here?
Well, you know, most people are looking at these events coming out of Europe and asking what they mean, what they're going to cause. But I think they're all results, and the results of the change that you just alluded to, a big change from extreme euphoria in 1999 and kind of a double top in euphoria in 2007 to what we've had since, which is a retrenchment in that mood. And people are less ebullient than they were, and that's all it has taken to show the weaknesses in the entire Euro structure and the entire EU structure as well.
So what signs should we be looking for, though, to figure out when this is the bottom? Is it political developments or economic developments or a certain measure of unemployment?
You know what, Lauren? It's the opposite of the things that we saw in 1998. We're going to see things break up and people looking belligerent and acting belligerent toward each other. We're going to see social unrest increase. We're going to see more regimes fall, and we're going to see more alliances break apart. And those are the kind of things that I expect to see at the low. And when people at that time come out and say, okay, this is proof that no one will ever cooperate again, I think we'll be on the other side, the very positive, bullish side, saying, no, this is a sign of a bottom, and we can look forward to many, many years of a positive change, very similar to what we had in 74 and 82 in that period in between.
So just to be clear, you think that there will be exits from the Eurozone and a breakup, and until then, we haven't seen a bottom?
Yeah, but it's not just that. I mean, we look at measures of optimism and pessimism. I think that's probably our strongest area in sentiment terms, in terms of the market. Mm-hmm. And there are many long-term sentiment indicators that are still pinned to the ceiling. There's still a lot of optimism, as there has been ever since 1998. We had a little decline in it on a long-term basis in the crisis of 2008-9. But it was just a minor blip in the overall historically optimistic mood, as I measure it by dividend yield and by the percentage of cash in mutual funds, just to give two examples. They're still at extreme levels. We're nowhere near a bottom on those. On a short-term basis, you could argue we're oversold, but the big picture is what matters here. The short-term picture just does not matter.
Okay. And looking at where we are now in terms of some pessimistic symbols, there's a chart that you feature in your report where you point to deterioration in confidence in banks as measured, in your view, by the decline in deposits in banks. Our viewers are looking at that chart right now. So the way the Eurosystem banks work, though, the way the central banks are set up, when local banks lose deposits, they can still operate through a recycling of funds from the ECB. So what would it take for this lack of confidence that you're showing there to manifest itself in terms of actual bank runs?
You know, it's not that easy because, as we've seen, the European Union has been depending on the solvent countries, such as Germany, to hold up the countries that are very, very weak and spending like drunken sailors. And that cannot continue. It has not been really the European Central Bank that's gone in and said, we don't need anybody to back this debt, we'll just do it ourselves. These, even though they're called central banks, they're still operating as banks, which means that their assets have to be good enough to back the money that they've sent out and lent out. And I think we're reaching the point where that is going to become a more important issue than it has in the past. I think particularly the Fed has assumed a lot of things they were buying would be perfectly good throughout the cycle. And I think once we head into this second drop, which is going to be a repeat, but I think even stronger than 2008, that's when people are going to start realizing that some of these assets may be suspect. And I think we're going to have some internal dissension in the central banks about what they should do. And I think we're definitely going to have political headwinds. We already had that somewhat when they were fighting over the budget here in the United States. I think you're going to see more and more of that in terms of, you know, it's not going to be as easy as they think to bail out just about everybody, particularly when most of the debts are bad, and that's my view. Mm-hmm,
yeah. And speaking of your view, last month in Global Markets Perspective in the forecast, you called for the rebirth of a global bear market. And then what did we see in May? The Dow plunged, worst month in 2 years. Our viewers are looking at the chart, closing down 6.2%. Commodities took a bigger hit, 10.8%. They were down. Oil dropping nearly 20%. But when you look at some of the calls for stimulus, for QE, which some investors may be hoping for, and some arguably have credited QE with boosting equity prices, how does that factor into your prognosis?
Well, think about this. Even though the Fed did record buying in 2008, they didn't even call it a QE. I call it QE zero, but it was $1 trillion worth of buying. 2 more QEs after that, QE1 and QE2, despite all of that massive inflation, and they've also helped bail out the European banks as well. Despite all of that, real estate is still down about 50%. As you pointed out, commodities are down, and they topped in 2008. That's 4 years ago. Oil topped back then as well. You have to go back to April 29th of 2011 to see the more recent highs. Number 1 in the New York Composite Index. Number 2 in the commodity index. Number 3 in the foreign currencies. Even silver topped on April 29th of 2011. People have kind of ignored that high, but I think it was crucially important. That, to me, was the real recovery high. We've made sort of a double top here in 2012. But this is despite all these massive attempts at inflation. You can only imagine what would happen if they really realize that there's too much to handle and start slowing that inflation pressure down. We're already in such a deflationary pressure situation that I think this is why the markets are finally beginning to yield.
So do you think that there's no amount of printing or stimulus that central banks can do to avoid the kind of deflation you see coming?
Well, if they just ran the presses, sure, they could. But what they're doing is they're trying to keep all of the debts out there in the world good. And they're doing it in two different ways. The central bank is doing it by taking value from savers. Every time they print more money, when they take in treasury bonds, they're stealing value from savers. And when the government does it by, say, guaranteeing the debts of Fannie and Freddie, which ideally should belong to the private people that took them on, they're putting the burden on innocent taxpayers. So this works for a while. You know, they can say, oh, the public is going to pay for all of this. At some point, the public's going to be annoyed. I think we've seen little sparks of that in the political arena already. And I think at some point, they're not going to be able to do that anymore. Social mood is in control. And when it really turns down, and that's going to be evidenced by lower stock prices even from here in coming months and probably in coming years, going to see one by one all these confident people beginning to express a lack thereof because their scenario won't be going as they expect. And once people feel a little disconcerted and uncertain, I think that's when you're really going to see the bear markets rage. And you know, ultimately, nature is stronger than a few directors. And I think we're going to see that in the next 4 years.
The power of the markets is going to overcome these technocrats trying to pull the levers. Although that pessimism that you said we've seen in hints, there's lots of reasons to be pessimistic about America's finance, chronic trade and budget deficits being just one, the debt debates we've seen, plenty of reasons. Despite this, what we see is these record lows that Treasury yields have been hitting against. On Friday, we saw a record-setting low for the 10-year Treasury yield that I think we have to show our viewers what it's been doing. So what do you think these types of unprecedented moves reflect?
I'm glad you asked that one, because we've been on the side of predicting lower interest rates throughout this entire period. And the economists calling for recovery we're calling for higher rates, and the bears calling for hyperinflation we're expecting higher rates. But I think we've been right that deflation is still the main, despite all of the attempts of the central banks, deflation is still the main force going on. And that shows up, as you just pointed out, in lower rates. In fact, the 10-year note is yielding the least that has yielded in the entire history of the United States going back 200 years. That is amazing. However, I think that even though people are saying it's a sign of short-term fear that people are buying these Treasury bonds, it's really also a sign of long-term complacency, because they're so sure that all the bonds they're buying, and some of them are treasuries, others are buying municipal bonds and even junk bonds, you know, they're very complacent that the people issuing these bonds are going to pay off. We're not so complacent. At some point in this cycle, as we head deeper into deflation, we're going to see rates begin to rise. And we think they've already started on the weaker end of the spectrum. Junk bond rates have begun to creep up. We think munis are beginning to creep up, and I think before it's over, it's even going to circle around to the treasuries. That's going to be the crisis time, just as we saw in Greece. When the crisis hit, rates soared. I think that's ahead at some point. So we have to be aware that even deflation can give you higher rates, but it's not because of, you know, the increase in inflationary purchasing power. It's because of fear of default.
Interesting. And before that happens, I want to ask you, when we get back from a break, how low you think Treasury yields can go in the interim. So hold on right there. We will have much more with Robert Prechter, author and founder of Elliot Wave International. Also still ahead, Spain may be suffering from massive unemployment, but one small village thinks there is something much more important to fund. We'll tell you what it is in Loose Change. But first, your closing market numbers.
Drives the world.
The fear-mongering used by politicians.
Who makes decisions?
Considerable breakthrough has already been made.
Who can you trust?
No one who is imbued with a global missionary zeal.
Where are we heading?
State-controlled capitalism is called fascism.
When nobody dares to ask, we do. RT, question more.
You know how sometimes you see a story and it seems so whole and complete, you think you understand it, and then you glimpse something else. You hear or see some other part of it and realize everything you thought you knew, you don't know? I'm Tom Hartman. Welcome to The Big Picture.
Welcome to the Alona Show, where you'll get the real headlines with none of the mercy. The problem with the mainstream media today is that they're completely disconnected from the viewers and from what actually matters to those viewers. And so that's why young people just don't watch TV anymore. If they want news, they go online and read it. But we're trying to take those stories that people actually care about and transfer them back to TV.
Welcome back. We're talking about deflation, among other things, with Robert Prechter, founder of Elliot Wave International and author of Conquer the Crash. You can survive and prosper in a deflationary depression. And before the break, Mr. Prechter, we were talking about yields, these record lows that we've seen for 10-year Treasury yields as just one benchmark. So you predict that ultimately we will see interest rates rise. But in the interim, how low do you think we could see these Treasury yields go?
Well, we think they're pretty much making bottom as we speak. This is a different change of opinion over the past 30 years, but we have many indications right now that they've gone a little bit to the point where people are now embracing the trend. As you know, all last year and in the first few months of this year, people just hated the bond market. They said, that's the worst. Everybody knows rates are going up. You don't want to own bonds. Well, now they're embracing them. The latest figure we just saw from the DSI, the Daily Sentiment Index on bonds, which is a poll of futures traders, shows that 97% of them are bullish. Now, the first time we got into the 90s was last August, and it's been hovering in that area with a few periods of exception all the way until now. That's a long time when traders have been very, very bullish. We've also got what we think is perhaps a completed Elliott Wave count there under the Elliott Wave model for rates on the 10-year Treasury note. We find large speculators have been chasing the trend, and generally when they do that, you're near an end of that. So we think for the first time, we've had the great 20-year move up in the stock market. We had a 10-year rise in precious metals, and we've also had a 30-year rise in bonds. And I think all of this is part of the great grand super cycle top and the biggest complacency in recorded history. So I think this may be the last big bull market that's topping out bonds.
Oh, wow. OK. And I know, obviously, forecasting is always a game of probabilities, and we can't sit here with a crystal ball and pinpoint it. But I am wondering, for anybody who follows Elliott Wave, as I know some of our viewers do, or who want to, what has been your success with timing, and how has that helped you or your investors, or your readers, rather, with their investments?
Well, let me give you a good example. 2 months ago, in April, I put out a special issue. I wanted to talk about the price of gasoline. Now, we already counted the oil market as over in April of 2011. That was an ABC rally, as we call it in Elliott Wave terms. It's a counter-trend move. Commodities and oil included peaked in 2008, had a terrific crash into late 08, early 09. And had recovered 62%, which is a normal retracement recovery. They traced out an ABC pattern. It was in a nice little channel. So we said in May last year, oil and the other commodities have topped. But this year in the spring, people started going crazy about gasoline prices. Now, consumer prices lag producer prices. So we were pretty sure that this is one of these lagging indicators, again, of believing in more inflation, more inflation, more inflation. That's the theme. So I put out a special report and I said, look, we've had predictions of $4.25 gasoline. That's the lowest we've seen. We've seen $5 a gallon, $6 a gallon, $7 a gallon, and $8 a gallon predicted in the last week and a half. This is a classic sign of a peak. So not only do we have an Elliott Wave reason to be negative or bearish, or I guess bullish if you want to buy gasoline on that price, but we think this is the kind of cusp of belief that occurs right at turns. And that was actually a week after The national average of gasoline prices peaked. They were $3.92 a gallon. They've fallen down into the 350s, I believe. Locally, you can buy gas at $3.33 where I live, and I've heard some places where it's even under $3. So that retracement has started, and it even speaks to other things. If you've got another minute, we can go on about that as well.
We do have limited time, and there's so much I want to get to. So I do want to ask you about a couple of other things that you've been talking about, which are really interesting. And one has to do with the stock market, which we've been talking a bit about. But in your report, you cited a Gallup survey that found that roughly 53% of households are still in the markets. That's, I guess, as of April. Now, this figure is down from 65% in 2007. Is this number still high in your view? And how long do you expect it to go, how low rather, before we reach a long-term bottom?
Historically, it's really high. I mean, the highest reading, I believe it occurred in 1928, 1929, was about 10% of the American public. And right after that, and of course for the century before that, it was much lower, single digits. And people just really embraced finance in the late 1960s. Then they kind of got tired of them in the 70s. But when the market turned up in 1982, that was it. They became married to finance. They loved it. It was one of the great booms of all time. It was triple the rise in percentage terms and triple the time of the 1920s great boom that we had back then. So people have embraced stocks, in fact, all over the world. I mean, we watched over those years as one by one former communist countries started having stock markets, you know, the Soviet Union and China and Vietnam, and it's incredible. So we were saying this is just a great, great fifth wave peak in global optimism, and look at all the results that it's giving us. Well, now that trend has turned, and so I think by the time it's over, we're going to be probably back in single digits in terms of people being interested in the stock market. The last big turn of this type was the South Sea bubble in England in 1720. The bear market lasted 64 years. And I'm sure 2 or 3 generations of people said, whatever you do, don't touch the stock market. So I think when you get to these extremes, and this one was even bigger in terms of low yield and overpriced values historically, generally you swing to the other direction. And since we haven't had any extremes in the other direction, we keep saying, look, we're not there yet. Be safe. Keep your powder dry. We're going to have a great opportunity once this market does make a bottom.
Well, and really interesting, we just saw the Facebook IPO, which was the most hyped IPO that we've seen in such a while, it seems. We have some headlines showing just how excited the media was, at least, about this IPO. And then, of course, we know what happened. It face planted. I think the stock was down around, what, $26 today? It opened at $38. So how does this, the performance of the Facebook's IPO, fit into your theories about the loss of retail investor interest in equities?
Lauren, that's such an important event. We were watching that and saying, this is another indication that we're not at any kind of low, because if we were at a bottom, A, they wouldn't have been able to do the deal. But B, if they did do the deal, it wouldn't have gone off at an extremely expensive price with all kinds of hype and everybody wanting to buy shares and wanting to buy shares for their kids. I think, by the way, it's going to be a great lesson for those kids who end up owning them, you know. They're going to learn something about the stock market. What we saw there was another microcosm of extreme optimism, people just rushing ahead to own it. It was as if we had a one-day reversal, the kind that we've had over many years in stocks and commodities and real estate and everything else that's gone crazy. So, yeah, I think it was very important and just told us, you know, if you think the market's just making a correction here, that's not right. People are still too willing to jump aboard something new.
And in addition to the Facebook IPO, we just have a second here, but we have seen a trend of just far fewer IPOs, and they've delivered less in that initial IPO. So what is that significant of to you?
That's a result of the bear market that's been going on since 2000. It's been subtle, and we've had 3 peaks, 2000, 2007, and basically now. But in the interim, it's really been a loss of real purchasing power in terms of what stocks are worth. The real value is topped in 2000. It's been 12 years. I think we got about 4 years to go. So time-wise, it's mostly over. But price is going to be the problem for the next 4 years.
All right. Good words to end on. So much more I want to talk about. We're going to have you on again as soon as possible because there's more to discuss. But I really appreciate you being on the show today, Robert Prechter. He's author and founder of Elliot Wave International. All right, before we leave, let's wrap up with a little bit of loose change. Dimitri and Shannon, what's going on? Let's talk about it. The New York Times is reporting that JP Morgan officials ignored warnings last year that could have kept them from this.
So banks either make loans or invest the money in securities. We have a huge securities portfolio. We're a big bank. In fact, the securities portfolio does have an unrealized gain of $8 billion. But in how we manage that portfolio, we did lose $2 billion trading.
That was his euphemistic explanation that has now become infamous. Now, a small group of shareholder advocates called CTW Investment Group said the bank's risk controls needed to be improved, and JP Morgan officials dismissed the warnings. So how shocking. We find out that the bank ignored risk warnings, but meanwhile, we've also received news that JP Morgan returned $600 million in funds held at the bank when MF Global collapsed. So are we seeing here kind of a tit for tat? Maybe JP Morgan's trying to, you know, give a little carrot here to avoid some of the sticks coming from this direction?
Well, what I found shocking is that all of a sudden Jamie said that they had MF Global money. I thought the money vaporized. All right. I think the other thing that's funny is that he said that banks make loans and that he has unrealized profits. Yeah, but he also has unrealized losses and potentially huge unrealized losses because they still have this quote hedge on, from what I understand. So
yeah, Dimitri, that's just how banks do business. I mean,
exactly.
that's just how it works.
That's how
just accept it and move on.
Well, JP Morgan's not a bank; it's a hedge fund.
Yeah,
it's a hedge fund that actually has a consumer lending arm.
Yeah,
and a commercial bank operation. So
okay, so we'll end on those words. Let's get to one more story because 1 in 4 people in Spain may be unemployed. We talk about it a lot, but one small Spanish town showed where they think their values are, what they think is more important than a jobs program. Take a look. So I'm talking about bullfighting. Reuters reports a small town voted in a referendum to keep its budget for bullfighting and other festivities and not divert part of the money into a jobs program. So maybe they just know that it's not the government's role to create jobs, that they're no good at it, and they'd rather just have their bullfighting, which they enjoy.
Yeah, and besides, if people want bullfighting, then that's a job, and that's something that the market is demanding. So, in my opinion, this town, good for them. You know, what are they going to do? What are they going to have?
Life is miserable. They just don't want to be deprived of their one joy in life, a major cultural thing that they enjoy, even if it is pretty brutal.
You can't calculate, quality of life. And these guys, this is part of their quality of life, bullfighting. You know, it may not be for you and me, pink socks, red capes, and bulls and stuff.
Bulls.
But maybe these guys like it.
All right. Maybe they do. Let's leave it there, because that's all we have time for. Thank you so much for watching, and please come back and watch our show tomorrow. And in the meantime, you can follow me on Twitter at Lauren Lister and give us feedback on the show at youtube.com/CapitalAccount. You should also subscribe if you haven't. Plus, you can catch our show in HD on Hulu at hulu.com/capital-account. And from everyone here, thanks for watching and have a great night.